Well, hello everyone. Welcome to our chapter 19 video lecture. We have a very exciting topic today, understanding securities markets for financing and investing opportunities. In chapter 19, we will focus on the functions of security markets, discuss different types of stock exchanges, how companies raise capital by selling stock and by issuing bonds, how investors, that's you, buy securities, how to invest in stocks, how to invest in bonds, invest in mutual funds, what we call ETF, exchange traded funds, and understanding stock market indicators. So, you ready? Let's go. Warren Buffett. Warren Buffett, the owner of Berkshire Hathaway, is one of our most prominent investors. He has a net worth of over $80 billion. He's one of the most richest people on the planet, and he spends a lot of time investing. So, we're going to talk about how to invest in the securities market. All right. So, the security markets is a marketplace for stocks and bonds. So it's through the security markets that companies and individuals are able to invest in stocks and bonds. Their primary function is to assist companies in finding long-term funding to finance capital needs. So if a company needs to acquire a new facility, automobiles, equipment, they may use securities as a source of funding and also provide private investors like you and me a place to buy and sell securities such as stocks and bonds. So I'm curious, do you own any stocks or any bonds? Okay. Motley Fool is a company that provides information about investing. They also provide you with educational information, tools of how to be successful in the securities market. So let's talk about the different types of securities market. There's a primary market and what we call a secondary market. It is the primary market that handles the sale of new securities. So when a company first goes public, which means that they're going to trade their stock on an open stock exchange market, they issue what's known as an IPO. An IPO stands for an initial public offer. This is the first time stock for this company is being made available to the public. So any company you think of, whether it's Tesla, Amazon, Google, etc., they've all went through the IPO process. Okay, so what happens is that these stocks or securities are typically sold to what we call investment firms, large financial institutions. Those investment firms then sell those securities on what we call the secondary market. That's the exchange occurred between investors, with the proceeds of the sale going to the actual seller. So keep in mind that the seller on the secondary market is not necessarily the company that issued the stock. It is the investment firms who purchase those stocks in the primary market. So in essence, when you buy stocks, you're not buying them directly from Google, Amazon, or Tesla, but you're buying them what we call the secondary market. Okay? Investment banks are specialists who assist in the issue and sale of new securities. It's their job to study these securities. Then these institutional investors are large organizations such as pension funds or mutual funds that invest their own funds or the funds of others. So if your company has a 401k plan, any type of retirement plan, most likely they're using some type of institutional investors, a company whose job is to create and oversee pension funds and or mutual funds. Stock exchange. It's an organization whose members can buy and sell securities for companies and investors. Okay, and there's different type of stock exchange that what we call the OTC, over the counter exchange, that provides a means to trade stocks not listed on the national exchanges. So there are some major companies that have their stock listed on the major stocks like the NASDAQ we talk about, the New York Stock Exchange. Over the counter are smaller companies who want to sell stock, but they're not listed on the larger stock exchange market. So NASDAQ is a nationwide electronic system that communicates over-the-counter trades to brokers. So NASDAQ allows you and I to purchase and sell stocks using these stock exchange markets. The New York Stock Exchange was once the largest floor-based exchange in the world. Here is where you have stockbrokers, stock investors who are buying and trading stock for their clients on a daily basis. Okay. Here are the top stock exchanges in the world. The New York Stock Exchange is one, the NASDAQ, the Japan, the London, Shanghai, and Hong Kong. These are the largest stock exchanges in the entire world. Okay? The federal agency in charge of regulating the various exchanges is it A, B, C, or D? If you said B, you're correct. The SEC will stand for the Securities and Exchange Commission. So let's talk a little bit more about who are the SEC and what is their responsibility. So the SEC is a federal agency that has responsibility for regulating the various exchanges that we just talked about on the previous slide. They were created way back in 1934 from Security and Exchange Act. Their role is to oversee information being provided by public companies who trade their stock on a public stock exchange, so that when you and I are buying stock, we're buying stock based upon reliable financial information. The Act established guidelines to prevent what we call insider trading. So, insider trading is when one person or company has information that's not made known to the public, and that information gives them an advantage over their competitors. That's illegal, and that's known as insider trading. Okay, now, before any company can issue stock, again, whether we're talking about AT&T, Walmart, etc., they must issue what's known as a prospectus. This is a condensed version of their economic and financial information that a company must file with the SEC before issuing stock. We want to know more about that company before we decide to buy stock. So the information may include things such as their balance sheet, profit and loss statement, statement of cash flow, just information about that company so that we can make an informed decision about our investment. The prospectus must be sent to prospective investors. So typically it's sent to those large investment firms as well as to the SEC. Okay? Now, how do companies raise capital by selling stock? Well, a company can sell ownership into their company by selling shares of stock. So, if you own one share of stock in any company, guess what? You are part owner of that business organization. That's what we call a stock certificate, which is evidence of stock ownership that specifies the name of the company, the number of shares, and the type of stock being issued. So now everything is pretty much done electronically. But even with that, when you go through TD Ameritrade, or Charles Schwab, or Robinhood, although you may not see it, there's actually a stock certificate with your information that shows you have ownership of stock in that particular company. Dividends are payments made to the stockholders of a business organization. So remember that when you are a stockholder, you are part owner. So when a firm makes a profit, they may distribute that profit to the stockholders in a cash payment, or they may give you the additional shares of stock. One is known as a cash dividend, the other will be called a stock dividend. There are advantages of issuing stock. So it's a great way to raise capital by companies by issuing stock. The stockholders or owners of a firm and never have to be repaid their investment. So when companies sell shares of stock, that company doesn't have to repay those stockholders because those stocks are being bought and traded in secondary market. So again, when you buy stock, you're actually buying it from an investment firm, not from the original company. Also, there is no legal obligation to pay dividends. The board of directors of that corporation will determine if and when they're going to pay out dividends. However, they're not obligated to pay out dividends to the stockholders. Stocks can improve a firm's balance sheet since it does not create any debt. So stock is considered equity financing, not debt financing. Okay? There are some disadvantages of issuing stock. Stockholders have the right to vote for a company's board of directors. So as I mentioned before, the board makes key decisions such as whether or not to issue dividends, as well as they may decide who they're going to hire as the CEO or president of the company. Issuing new shares of stock can thus alter the control of the firm. So if you buy stock in a company and you become what we call a majority stockholder, meaning you own at least 51% of that company's voting stock, then you can control that business organization. Dividends are paid from after-tax profits and are not tax deductible. So dividends are not an expense shown on the income statement. The need to keep stockholders happy can affect decisions by management. So you want to make sure that you are providing a return to your stockholders and that you're keeping your stockholders happy. So the most common type of stock will be called common stock. So typically when you buy stock, you're going to purchase common stock. Common stock gives you the right to vote and the right to share in the profits of that business organization. Okay? So typically when you own common stock in the company, you receive what's called a proxy statement on occasion. That statement allows you to vote on key factors such as who may become members of that company's board of directors. And that's important because the board of directors are going to make key decisions about that business organization. So I encourage you that if you are a stockholder and you receive a proxy vote, vote on who becomes part of your board of directors. Okay? Remember that it's the board that will approve whether or not dividends are going to be issued to the stockholders. Purchase new shares of common stock before anyone else. So these are some of the characteristics of what's known as common stock. Okay? So again, I mentioned the IPO. When Pinterest issued their IPO, the company raised $1.4 billion by issuing shares of stock. The question is, can you see why issue stock can be an appealing option for financing company's growth? Please send me your response via email. Okay? That will conclude part 1 of our chapter 19 video lecture. Stay tuned for part 2. Bye-bye.